Hey everyone, it's Pete Carmasino here at Chaikin Analytics. I'm the Chief Market Strategist, and each and every week we kind of bring some of our articles to life here on the Chaikin Power Feed video series. And this week I actually will be talking about two different articles. They kind of mesh together nicely, so I wanted to make sure we made that point today, especially today, because we had some economic news come out today, this morning that has kind of obviously knocked the market off its off balance slightly. And obviously we've been getting this pullback. We've been talking about this. It's not, it's no secret. And, typical pullbacks, 5-6% are nice. 10% is a correction, and that's healthy. And that's kind of where we're at right now. But a few things have been going on. Early on in April, I basically put an article together, and it was basically talking about a riptide. It was a riptide warning, right? And you should go out and take a look at it. I'm actually pulling it right now, taking a look at what I actually wrote. And I was talking about a lot of things happening, other sectors starting to outperform. You started to see some hard asset sectors, the commodity area of the market starting to really move higher. And in that specific article, I talked about just specific sectors too. You had the industrial sector, materials, energy, of course, gold, and even silver were really starting to rally, really outperforming a lot of the stock and equity indexes out there. Now, I used a word in this article called stagflation, which is obviously very slow growth. And when we start to get that along with inflationary prices and that feeling in the market, right, people start to use the word stagflation. So you might start to hear that, but I just wanted to call that out to make sure that you took a look at how far back this has been happening, right? This is over a month ago, April 1st, I wrote that. And obviously, this is an election year, and a different article is talking about a potential pullback, right? So you're getting both of these kind of happening right around the time what we call seasonality here in the market. And there is a seasonality to the markets in general, but in election years, you might see a little bit more of a whipsaw, obviously, for multiple reasons. But this year specifically, because we've got geopolitical risks and other things that are happening out there, obviously with interest rates, inflation, the dollar, it just never ends. So, that's part of the markets, and that's part of understanding sort of the mechanics of the market. And you could see on the power gauge, when we were looking at some different areas of the market, some were moving higher, others were moving lower. So you're getting an upgrade on the sectors that are moving higher, like industrials and materials, getting a downgrade on some of the names that are moving lower, like obviously staples and even technology to a degree, right? So you're starting to see a bit of a rotation now. None of these are really all-out sell signals or all-out buy signals. There's sort of a migration, right, in and out of risk. And that's kind of what the power gauge helps us kind of identify. But in general, understanding the market mechanics and then going into the power gauge and taking a look, you get to validate some of your thoughts. And not only that, but it brings confidence to your investment decisions. So we're going to look at just the market in general, where that pullback might bring us to on the S&P. And that's kind of where we're going to draw the line in the sand, that 10% pullback on the SPY. So let's look at that chart right now. All right, I'm sharing my screen now. I took a snapshot of the SPY, which is the S&P 500 ETF, the fund that's been around for quite some time now. And this is an estimate, folks. I mean, it's a 10% off the high where the SPY traded in that 524 area, and obviously down to where it could start to find support. And I drew this longer line because you can see right here, there's a consolidation of price back here between December and January, really even back as far as November, December, and parts of January, beginning of this year. So if we can get to that 472.50 to 473.50, you can extrapolate that on the actual index. Just move the decimal point over, right? It would be 47.25 to 47.35, but the S&P trades in this ETF sort of at a fractional price. So you're seeing it down 4 points. That's really 40 points. Showing 500, that's really 5,000. So you kind of understand how that works. But, I drew this line to show you kind of where it might end up and where we might consider that a healthy pullback. That's the first chart I wanted to look at. We'll look at the Qs next, just to make sure we're not missing anything on that index. I wanted to look at the Qs here before we ended the video, and we're going to look at the two other sectors as well that we were calling out back in the beginning of April as being, outperforming the general market. Now, here's the Qs, obviously a tech-heavy index. Now, breaking down, showing a weak trend, it's starting to flatten out a little bit, and we do have a relative strength change here. So, a little bit of a clue, that things kind of a little toppy here, and you can see sort of where it was sort of bottoming out around that 435 to 440 area, and then finally broke down a little bit. Now, again, we're hoping to see maybe that pullback. As I said, if you're looking at the high up here of around, call it 450, 405 would be about a 10% pullback, and that puts it in the same realm and time frame as the S&P as well. So I'd like to see both of those work at the same time. That would be, ideal to kind of validate it. But let's go back and look at XLI. You see that's actually the industrial sector ETF. That's been bullish, and that started to get bullish around that February timeframe. But things really started to heat up at the end of February, beginning of March, when it started to move higher. That's when I wrote the article about, things have been heating up in the commodity area, industrial sector as well. And if you look at XLB, was the other one I wrote about. Again, the material sector, a lot of chemical stocks in this particular sector, but almost the same identical pattern. You broke a double top here, right around that $85, $86 level, had good money flow, and obviously started to see a relative strength change and a bullish rating change. So when you get all those things together, as I said in the beginning of the video, the confidence in what you're looking at sort of increases along the way. And so that's kind of where I saw stagflation creeping up, maybe before most people did. So once again, folks, stagflation is kind of a word you might start to hear more of. Again, we talked about it in several articles in the last month or so, beginning April 1st, about how commodities were heating up, and specifically gold, industrials, and materials. And we don't rate gold, but it's a commodity, but that was already, the performance was there. So the flip side is that, why did that happen today? Well, because when you start to see data that comes out that shows poor economic growth coupled with hotter, again, the PCE, and the continued tight labor market conditions, kind of reaffirmed today by the jobless claims. You kind of get that feeling like, okay, well, potentially, maybe that's where we're at now. Again, a lot of things going on. So 10% pullback is healthy. Let's not get overexcited, but let's see where this thing goes. And we'll be back next week with another video. Take care. Talk to you soon.